Justin Curlow, you are Global Head of Research and Strategy at AXA IM Real Assets. Thank you for joining us on BiTV.
Thank you for having me.
As we are hopefully coming out of the COVID-19 crisis with a progress of vaccination programs, what are your projections on the recovery of the European real asset sector?
I think you're exactly right with the framing of the question. We've now got a roadmap to recovery, with the vaccines being developed towards the end of last year, ordered and starting to administered to the populations year to date. When we look on the continent in Europe, we're seeing a rapid acceleration in the order and in the administration of those vaccines. But I think the roadmap to recovery is a little bit more complicated than just getting the vaccines ordered and starting to be administered. We need to reach that critical herd immunity. And I think that's where we've got a diverging prospect across some of the European countries, whereby some of the populations, through various surveys, have acknowledged a reticence or reluctance to actually be vaccinated. Southern Europe was very well advanced in terms of a high level of willingness alongside the UK, whereas France, Northern Europe, Germany, somewhere in between. So I think there are varying levels to which we've got a willingness of the population to accept and take those vaccines. So I think that kind of gives us the roadmap to reopen the economies. In terms of timing, the US is probably furthest advanced, already starting to reopen. There's anecdotal evidence that, leasing activity in the office market is seeing a big resurgence. There's activity in the airline industry, in the hotel industry, with destinations for leisure travel like Florida or the Caribbean actually eclipsing pre-COVID peak levels. So I think that's really encouraging on the leisure side of the equation, and hopefully is a precursor to what we'll be able to enjoy here in Europe. But I think the UK is leading the continent, and I think the US and UK are expected to reach some level of herd immunity by middle of this year, with the continent probably lagging and probably seeing herd immunity being reached in Q3 or Q4. So getting back to your question of how do we see that within the real asset standpoint, I think when we look to the real estate segments, we would combine that recovery prospect between the defensive sectors that have proven their resilience, those that are underpinned by demographic, structural, long-term thematic anchors, versus those that have been highly geared towards the disruption that COVID-19 has had, i.e. those that are reliant on physical interaction like retail and hospitality. And I think we can now start to think more holistically around both the defensive and offensive sector strategies, where previously we were very much focused purely on those defensive thematics.
Okay. And in a recent note, you stated that renewed inflation risks are leading to a consequential rise in interest rates. How could this situation impact European real estate investors?
So what we've seen on the interest rate side of the equation is effectively huge amount of coordinated monetary and fiscal policy stimulus to try and support these economies, these industries and business segments that have been most negatively impacted or disrupted as a consequence of COVID-19. I think it's important to emphasize the COVID-19 pandemic is different from the GFC in that there was no clear villain. When we look at the GFC, there was a finance segment, a banking segment that clearly fueled the financial crisis, and therefore meant there wasn't the political willpower to be able to bail out en masse and provide a significant amount of stimulus. By contrast, when we look at the COVID-19 pandemic, it impacts everyone. We've all felt the impacts of lockdown. Some of us more fortunate than others have been able to work through it. Those in the retail, hospitality segment, or any part of the economy that relies on that physical interaction have been most disrupted. But luckily, because we're all in this together and because we've all felt the impact, it means that governments have the support of the population and their electorate to do what they need to from a fiscal standpoint, and central bankers have the backing of the government and the population to do what they need to do from a monetary standpoint. So there's been a huge amount of capital flood into the economies to help support those industries and businesses most in need, which I think is encouragingly part of the reason why we haven't seen a lot of distress within some of the property segments, despite the disruption to revenues and incomes that had clearly been a consequence of the COVID-19 pandemic. Those are clearly starting to normalize as we start to reopen these economies, as we've got this roadmap to recovery. But I think what's also been leading to the interest rate situation, and what was highlighted in the note that you referenced, was the fact that we've got a new administration in the US with the Biden administration having enacted a huge fiscal stimulus package that is leading to expectations or concerns around inflationary pressures, and we're starting to see some of those come through in the data. Ultimately, our economics team within AXIM has done a lot of work looking at pandemics historically and have commented on and published on the fact that pandemics historically have not been inflationary by in and of themselves, but actually the inflation is transitory. So we don't think that inflation is likely to stick and be around here for the medium or long term. But ultimately, this uptick in inflation is leading the financial markets to respond with an anticipation that central banks may start to raise interest rates and tighten monetary policy quicker than previously expected. I think what's important to emphasize here is rising interest rates do not equal high interest rates. We're still expected to be in a very low interest rate environment, particularly here in Europe, where we don't have the same level of fiscal support that's coming through, even if there are pockets of that. But ultimately, what we're expecting from a real asset and a pricing standpoint is that continued outsized yield spread, where cap rates or property yields today are very, very high or significantly above the 10-year either government or corporate bond reference rate. And therefore, we've got a huge buffer to be able to absorb that initial increase in interest rates.
Okay. You alluded to it earlier. After having been mostly defensive, over the last 18 months, how should real estate investors navigate this context of COVID recovery?
While we've got a roadmap to recovery, we're far from out of the woods yet. We think we still need to be defensive in the way that we approach real estate and infrastructure investing in the current market context. But I think what's very important is the fact that we do now have that roadmap to recovery. So those more offensive plays of retail hospitality become a little bit more underwritable. They're still very challenging. We're not expecting people to get back into retail spaces en masse. We don't think business and leisure travel is going to recover at the same pace. I think I mentioned it at the outset, leisure travel is likely to see the most swift rebound, as we're already seeing evidence of that in the US as it's reopening. But I think really what we've got to today is the fork in the road, where we now have that roadmap to recovery. Even if the timing isn't exactly 100% certain, we know the roadmap is there. We're on our way. Over the short term, and by short term, I would reference the next 12 to 18 months, we continue to be very, very focused on the defensive sectors, those that have been underpinned by demographic, structural, or overarching thematic anchors that are kind of a through cycle focus. So things like logistics, the wider living area, including everything from purpose-built student accommodation through multifamily PRS and senior housing, areas that are underpinned by some of the aging population, some of the digitization. So areas like life sciences, data centers, another couple of examples. These are long-term thematic anchors that have a huge demand side tailwind that make them defensive, regardless of where the economic and business cycle is. They have been a huge area of focus for us over the course of the past 3 to 5 years, even before the COVID-19 pandemic. And I think they've proven their resilience throughout the pandemic, and the fact that that demand side tailwind remains in place. That's not at all to say that we had any idea that this COVID-19 pandemic is what was going to disrupt the economic and business cycle. But I think those long-term thematic anchors have proven themselves throughout the disruption that we've seen. But as we start to transition out of this lockdown, out of this COVID-19 pandemic, once we do manage to reach herd immunity in these economies and reopen things and get to what the new reality or new normal is, even if that's not clear today, I think we can start to think more carefully and with a little bit more conviction around the timing of the recovery in the retail area, around the timing of the recovery and the nuance between leisure travel, business travel, long-haul travel, what that means for airports, what that means for hotels, the hospitality industry. And I think those segments become eminently more underwritable in the not too distant future.
Okay, well, thank you very much for this insight, and thank you all for joining us. See you soon on BiTV.
Thank you.